Right now, two people inside the same White House are sending the market two completely opposite signals about the dollar, and almost nobody's put them side by side. One is spending this month proving the dollar can be used as a weapon, cutting a country off from it entirely. The other is on record questioning whether having the world's reserve currency is even good for America in the first place. Both of those things are true at the same time, right now. And by the end of this video, you'll understand why that contradiction is actually the most useful lens for reading everything gold and silver have done this month. Quick ask before we go further. Subscribe if this kind of breakdown is useful. And tell me in the comments, do you think this administration is quietly preparing the ground for a smaller dollar roll over time? Or is this just noise that gets forgotten in a month? I want to see where this audience actually lands, because it's genuinely split even among people who follow this closely. Let's start with the clip that's actually been circulating this past week, because the context matters more than the soundbite. Vice President JD Vance has been quoted saying that reserve currency status might be, in his words, akin to coal in Appalachia, a resource curse. That clip went viral this week after an economic historian dug it up and posted it. But here's the part almost no coverage got right. It's not new. It's from 2023, when Vance was still a senator, questioning then Fed Chair Jerome Powell, arguing that the privilege of issuing the world's reserve currency lets Americans consume cheaply and borrow almost without limit, but at the cost of hollowing out the domestic industrial base. The same trap, in his telling, that left parts of Appalachia poor despite sitting on valuable coal. It resurfaced now, 3 years later, precisely because it sits so awkwardly next to his own administration's current strategy, which is built around stablecoin legislation designed explicitly to expand global demand for dollars, not shrink it. Before we move further into today's topic, I want to quickly recommend something that I genuinely believe can be valuable, especially if you're serious about understanding precious metals. The book is called The Precious Metals Trap. And honestly, this isn't just another book about gold and silver prices. It goes much deeper into the psychology, risks, common mistakes, hidden markups, and the traps that precious metals investors often overlook, because so many of you ask for it. So, if you've been thinking about getting it, don't wait until the offer is gone. Go ahead and check it out for yourself. Once you actually go through the information inside, you'll understand why I believe this book can be so valuable for anyone who wants to take precious metals seriously. And if you're still thinking, what if this book isn't actually useful for me? That's exactly why I've also included a one-day refund policy. It's simple. Get the book, go through it, see the information for yourself, and then decide. I don't want you to simply take my word for it. Check it for yourself. That's the only way you'll really see how much valuable, practical, and knowledge-filled information is inside. If you want to understand gold and silver beyond headlines and daily price movements, and actually go deeper into what every precious metals investor should know, I'd strongly recommend giving it a look. The link is in both the description and the pinned comment. So, if you've been waiting to get it, today is the day to check it out before the 50% offer ends. Now, let's get back to today's topic. That contrast is worth sitting with for a second, because it's not just an old clip embarrassing a politician. It's a real fault line in how this administration actually thinks about the dollar's future, and Treasury Secretary Scott Bessent sits right on top of it. Earlier this year, Bessent himself said something that got far less attention than it probably deserved. Gold can't have a budget deficit. Gold can't have a war. That's the Treasury Secretary. The person literally in charge of defending the dollar system publicly acknowledging gold's appeal as something that exists outside of fiscal and political risk entirely. You don't have to read too much into one line, but it's a genuinely unusual thing for a sitting Treasury Secretary to say out loud. Here's why none of this is just political theater. Layer the actual events of this month on top of it. The national debt closed above $40 trillion for the first time on August 20th. Days later, Treasury announced it would double its long-end bond buyback ceiling from $2 billion to $4 billion per operation starting September 9th, after the 30-year yield touched its highest level in roughly 2 decades. And separately, something we've covered in more depth in an earlier video, so I'll keep this part brief. The Treasury just formally named gold as a sanctionable sector for the first time in a sweeping new round of sanctions on Iran. Whatever you make of any one of these individually, together they paint a picture of an administration weaponizing the dollar abroad, while simultaneously running the exact kind of domestic fiscal and monetary maneuvering that tends to push people toward the assets a government can't print more of. That combination hasn't gone unnoticed by people who move real money. On August 21st, Bridgewater founder Ray Dalio published a LinkedIn post recommending investors underweight bonds and hold somewhere between 10 and 15% of a portfolio in gold, plus a smaller position in Bitcoin. His reasoning was arithmetic, not sentiment. He estimates the federal government will collect around $5.5 trillion in revenue this year against $7.5 trillion in spending, a $2 trillion shortfall, with roughly $10 trillion of debt needing to be refinanced and interest costs alone running near $1 trillion. On that math, he put a rough window on a potential U.S. debt crisis of 3 years, give or take 2, deliberately vague. And he was clear that isn't a certainty, just a risk worth pricing in. 4 days later, Goldman Sachs published its own note flagging something different but related. Gold call option demand has risen sharply enough that dealer hedging is now acting as what the bank called a mechanical price amplifier, capable of pushing gold beyond its existing $4,900 year-end target, while cautioning the same mechanism works just as violently in reverse if sentiment turns. 2 very different types of analysis, arriving independently within days of each other, pointing at the same underlying pressure. Here's the rehook. Because everything above is context, Friday is where it actually gets tested. New Fed Chair Kevin Warsh delivers his first Jackson Hole keynote this Friday, August 28th, and it matters more than a routine speech would, for a specific reason. Warsh has deliberately pulled back on the kind of forward guidance markets got used to from his predecessor, which means there's very little for anyone to anchor expectations on. That combination, a genuinely new chair, minimal pre-signaling, and a backdrop that's loaded with debt, buybacks, and sanctions news, is exactly the kind of setup where a speech everyone expects to be forgettable has the most room to actually move markets. And there's real precedent for that. At this same event in August 2022, then Chair Jerome Powell gave brief, unexpectedly hawkish remarks that most people had assumed would be a non-event. And the S&P 500 dropped roughly 3.5% that same afternoon. A genuinely large one-day move triggered by a speech nobody thought would matter. That's not a guarantee anything similar happens this Friday. It's a reason not to assume this one is automatically boring just because most people expect it to be. I want to be honest about the parts of this story that are more fragile than they sound, because that matters if you're actually trying to use any of it. The Vance clip is 3 years old and doesn't necessarily reflect his current view, let alone administration policy treating a resurfaced 2023 comment as breaking news about today's dollar strategy would be a mistake. And it's one version of this story is making. Gold has already run hard this month, and a metal that's climbed double digits in a few weeks, pulling back or consolidating, wouldn't contradict anything in this video. It would just be normal. And a genuine shift in the dollar's global role, if one is actually happening, plays out over years or decades, not over a single Friday morning speech, however much attention that speech deservedly gets this week. So, here's where that leaves things. You've got a sitting vice president whose old, resurfaced words cut against his own administration's current dollar strategy. A Treasury Secretary who's mused publicly, however briefly, about what makes gold different from a currency. A debt load past $40 trillion, a bond buyback program expanding again, and a formal sanctions action that put gold in U.S. foreign policy for the first time. Ray Dalio and Goldman Sachs working independently, both pointing at pressure building in the same place within days of each other. And a brand new Fed chair about to speak in a format that has, at this exact venue, moved markets sharply before. None of that is a prediction. It's a genuinely unusual amount of signal arriving in the same short window, and it's worth watching Friday with that context rather than without it. If you want me to break down Warsh's actual remarks the moment they land, subscribe and let me know in the comments. This isn't financial advice. Do your own research before acting on anything here. But now you're watching Friday with the full picture instead of just a headline.